All right, please open your textbooks to page 26 and workbooks to page 16. I'm going to take you through how to do transactions that have an effect on owner's equity, or more specifically, the capital account. First, I want to do a quick reminder with you. There are 4 things that cause capital or owner's equity to change. All right, 2 are positive, 2 are negative. The 2 positives are investments and revenue, and that's money coming into the business. And remember, we've talked about investments is actually going to say the word investment, where the owner brings in money to make the business more valuable. And revenue, whenever we sell things, we could sell them and get money right away, or we could sell them and get our money later. Either way, it's still a revenue, no matter when we get the money. There's also 2 negative things. The 2 negative things that affect owner's equity or our capital account are withdrawals and expenses. And just remember, think of it this way: withdraw, you're just taking money away from the business. You're not replacing it with anything. The owner's just taking it away and doing whatever he or she wants with it. Expenses, they're a little different than an asset. When you buy supplies, yeah, you're losing money, but you're replacing that money with an item, a supply. Typical expenses, though, you're not gonna be replacing the money with anything. For instance, paying your rent. Once you pay your rent for the month, that money's gone. You can't get it back. If you pay a phone bill, all right, you're paying for the bill, the use of the phone. You can't get that money back. You've already used your phone and paid for it now. Your electric bill, you've already used the electricity. Now you're paying the bill. You can't get it back. So those would be examples of expenses. So we're going to see some of those as we go through the problem. All right. If you notice in your workbook, you already have some numbers up here. We're assuming this is not a brand new business, so they already have some numbers to start. And you actually have number 1 done for you, but I have it covered just because I want to go over it with you. So let's read it together on page 27, actually, is where that starts. It said, paid cash for rent. By this point in time, we are all familiar with the idea of paying cash. Cash is going down, as you can see in your workbook, by $400. Now, when you pay for rent, that's one of those things. We're paying for something that we can't sell and get our money back. All right? So in this case, it doesn't mention anyone's name. It doesn't mention either of these companies. We're not buying supplies. We're not buying insurance. There's only one other place to put it. That's under the capital account, and you need to label it an expense. So that way we know exactly what it was. Once you do that, you got to do your math in all these boxes and get your new number. So 725 minus 400 is 325. This didn't change, didn't change, didn't change, didn't change. But this one, now our capital went down by 400. So let's take a look at number 2. Owner withdrew equity in the form of cash. It's one of those weird ones. It doesn't say the common 2 words we're used to, paid cash, but if you read it, that's what's happening. We're losing cash again. So we're going to subtract the 150, and now we got to figure out what's happening. Now they kind of give you a key word. If you go back and look, it says withdrew. Well, if you remember, back up here, we have an actual effect on owner's equity called withdrawals, so that's what it's going to be, and it's a negative. So what we're going to do is subtract 150 from the capital account and label it withdrawal. And do your math again. Subtract, nothing, nothing changed, nothing changed, nothing changed, and subtract. All right. Next one, number 3. Received cash from sales. Well, we all know what received cash is. Those are common words we've seen a lot. If we're receiving it, it's going up. So we're going to add to cash. Right. Then the second part of it says sales. All right. Sales is one of those new things that we learned is called revenue. Anytime we sell, we are earning money, and it's revenue. So in this case, it goes under our capital account as a plus, not a minus, and we label it with revenue, REV, or an R. And do your math. Make sure you add, don't subtract. Nothing, nothing. Add again. Number 4, paid cash for camera repairs. We are not buying a camera. We are paying for the service of a repair. Once we do that, we can't get that money back. It is gone. Now, later on, sometime we could sell the camera, but that's not what the concern is right here. It's the repairs. So the first part's easy, paid cash. Well, we're going to lose money. For camera repairs, I just got done describing, it doesn't mention a name for any company, so we're not going to put anything there. It's not on account. Not buying supplies, not buying insurance, so it only has one other place to go, and that would be an expense. Oops, and subtract. So make sure you subtract these two. The rest, nothing changes. Number 5, sold services on account to Eden Wedding Planners. Let's deal with that first word, sold. Sold or sales, we're selling. It's going to be a revenue. Sold or sales, revenue, and it goes under capital, plus 400, because that's a good thing, we're selling. Now in this case, unlike number 3, we're not getting the money right away. They're going to pay us later. We still put down the revenue, but we need to mark it down somewhere that, hey, we need to collect money from this company or these people. So we actually have an account for them right here, accounts receivable, Eden Wedding Planners. So what we do is we add it to their account, and that just reminds us that in the future we need to call them or send them a bill, and they need to pay us the 400. So make sure you add those two up. The rest, just bring down the number. Okay. Number 6, receive cash from sales. We already did one of these. Number 3, it's the same thing. Sales is revenue. Receive cash, we know that one. Do your math. Add. Nothing changed, nothing changed. Add. Number 7, paid cash for charitable contributions. Even though it's a little tricky, it seems like a good thing. We're donating to charity, but it's still, we're losing money, right? And it's money that we can't get back. Once you donate it, it's gone. You can't sell it to get it back because you're not buying anything. And that falls under the category of expense. So paid cash, we know that one. And in this case, it's an expense. Do your math, make sure you subtract the 2 on the ends, and then the rest, nothing changed. Number 8. Now finally that the Eden Wedding Planners, they're giving us some money that they owe. Remember, they owe us $400, but this says received cash on account from Eden Wedding Planners $300. So they're not giving us everything yet, but they're giving us some. All right. So let's deal with the first part though, received cash. We know that one, we're getting money. But in this case, we are actually going to subtract because we want to show that they are paying us some. Now, as you can see, if we do this math right here, they still owe us $100, and we'll get that later, hopefully. And then go ahead and do your final math. All right. Oops. Bring down, bring down, bring down, add the cash. Here's your final numbers. Now what you can do, again, to double check, you can add up all 4 of these and both of these, and it should be the same total on each side. All right, keeps your accounting equation equal.